Finally, as it's approaching the end of the year, it's also approaching the time when we catch up with Accounting the Cost regular. Stephen King is the chief economist at global bank HSBC, and this year he's got a theory about where the global economy is headed, and it's potentially nowhere. Because while some countries want to start raising interest rates after years of stimulus, others need to do the opposite to kickstart their flagging economies. It is, as Stephen King puts it, a monetary tug-of-war, which sounds like the kind of thing which just can't be good for the global economy. Monetary tug-of-war?
Yes.
Give me the précis outline first of who's on either side of the rope.
Very simple point here, which is that the markets expect the US and the UK to be tightening monetary policy in 2015. And the markets also expect the ECB, the European Central Bank, and the Bank of Japan to be doing exactly the opposite. So whereas the markets expect interest rates to rise in the US and the UK, they're expecting some version of unconventional policies from the other two, basically more in the way of quantitative easing, government bond purchases, purchases of other kinds of assets, all in an attempt to try to kickstart these economies. But the reason why it's a tug of war is that, in one sense, whatever the European Central Bank or the Bank of Japan try to do through these unconventional policies, the most likely way it's going to have any impact is through currency depreciation. And in one sense, that's simply a mechanism to export deflation from the Eurozone or from Japan into the US and the UK.
Right, so this is the point I was going to get. I wanted to figure out how it all comes together, because really, in the end, those different countries and those different areas need to look after their own needs. And if it means tightening monetary policy, or if it means quantitative easing, they're going to do what is ultimately best for them, first and foremost, ahead of the quote-unquote global economy.
That's correct, but the problem with doing it for yourself is that you may be unaware of the consequences for other countries, which then have a feedback into what you yourself are doing. So let's say that the ambition globally is to get rid of deflation. Well, if the Europeans simply loosen policy, devalue the euro quite a long way, then rather than getting rid of deflation, they simply shipped it across to the other side of the Atlantic, to the US, which may find next year that perhaps growth and inflation is a lot lower than people currently expect, precisely because of, let's say, the impact of a strong dollar. The risk is that someone somewhere is going to be disappointed.
Right, okay. Let's look at the Eurozone. It needs to do something, quite simply,
Yes.
doesn't it? Because of the fact that we're even still having this conversation in 2014 is quite something, given what the Greece crisis with 2008-9. I mean, this shouldn't have gone on this long.
This is an ongoing process over a number of years.
Yeah, fair enough.
Yes.
And it was a big problem to fix, but I'm wondering, sort of 6 years down the track, if we really should have been a bit more advanced by this stage.
Well, indeed. I mean, part of the problem with Draghi 2 years ago saying he'd do whatever it takes is that just before he said that, at the height of the sovereign bond crisis, there were the beginnings of a belief that perhaps there had to be institutional reform within the Eurozone, things like creating some kind of fiscal union. But once the monetary magic worked, the pressure to create that fiscal union began to fade, and the reform zeal that might have been there earlier began to go away.
So they took their foot off the gas, basically?
They took their foot off the gas, basically. They took the monetary drugs and benefited from that, but then forgot about all the structural reform. The last thing you want when you've got lots and lots of debt is deflation, and that's precisely the direction in which the Eurozone is currently heading.
So, in your view, is quantitative easing the right way to go? Will that actually make, well, what type of difference will it make, I guess, is what I'm saying. You look at Japan, where it works for the richer people, for the markets, for people with lots of money, basically, and it doesn't seem to work for everyone else.
Yes.
If you're going to go down this QE road in Europe, you've got to make it actually work for the people.
Well, there's a big problem here, which is that the asset markets themselves will likely respond in a positive way to QE, but the original intention of QE in other countries was that by lifting asset prices, like stocks and corporate bonds, the hope was that companies could then raise funds through the capital markets much more easily. The problem in the Eurozone is the capital markets are very small. Much of the funding for companies comes from banks, not from capital markets. But also importantly, in the Eurozone, bond yields, government bond yields, are already very, very low. So it's not obvious how much further they could fall with QE. So you've really come back to the currency, that the big swing factor that might have an impact on the Eurozone over the next 12 months is a possible fall in the currency, in exactly the same way that the yen, for example, has fallen over the last 12 to 18 months. But then you have the kind of distributional problem, which is that the rise in asset prices benefits the already rich, who own lots of assets. The fall in the currency tends to drive up import prices. And unless wages respond to that by themselves going up, the reality is that many households find themselves paying a bigger bill for their imports without seeing higher wages. They're actually worse off rather than being better off, which is not really the original intention of these kinds of monetary stimulus measures.
Let's widen out a bit further. BRICS, a very broad word to describe developing nations or emerging nations, but not quite the growth engines that they used to be.
Not at all. In fact, the big surprise in our own forecast at HSBC has been persistent downgrades to many parts of the emerging world. They went through a kind of a really strong, powerful phase between, say, 2009 and 2012, partly because of the strength of China, and China itself has faded, partly because they benefited from the fact that the US in particular was being very generous with its monetary policies. That led to lots of hot money flows going into many emerging markets. The problem now, I think, is that you've seen, in some cases, countries benefiting from loose monetary conditions, but not delivering structural reforms at the same time, allowing their wages to rise very swiftly, even though productivity gains were actually very, very slim. And the consequence of that is that they've lost competitiveness. One consequence of that is that their trade positions, their balance of payments positions, have got a lot worse over the last 2 or 3 years. So a worse balance of payments position, a lack of hot money inflows, it's not a great combination. So they suddenly find themselves with downward pressure on their currencies, downward pressure in terms of economic growth, upward pressure on inflation. And you look at countries in Latin America, and they're very, very good examples of where you have this sort of rather nasty combination of big trade deficit, high inflation, recession, countries like Brazil, Argentina, in that kind of situation.
You did mention China. Can you give me a brief outlook on China? Because that is, I mean, at the start of our interview, we talked about economies that affect other economies, and that is the most important one, arguably.
And what's happened post-financial crisis is that export growth has slowed down a long way. It's rising at between 5 and 10% a year, so a lot softer than was the case previously. And China tried to offset the weakness of exports by boosting domestic demand, and in particular, boosting infrastructure investment. But it looks as though the returns on some of that investment, perhaps at least in the short run, have been lower than was anticipated. And of course, if the returns on investment are lower than you thought, it's likely your growth rate will also be lower than you thought. So China slowed down from a growth rate of 9-10% a year to around about 7% or so a year, which is, by any other country's standards, still pretty good.
Exactly.
But the point is that at the margin, that slowdown is worrisome for the rest of the world, because of course it means that China is no longer quite the engine of growth that it was previously, particularly unhelpful for commodity producers around the world who clearly benefited from the earlier period of tremendous, rapid Chinese expansion.
Stephen, thank you so much for your time.
Thank you.
Cheers.
Thank you.